My name is Lori, and I am the Building Blocks Community Manager here at Handle. We are a community of credit, finance, and accounting professionals, specifically within the construction and building materials suppliers industry. Please follow me on LinkedIn. You will stay informed of all the different webinars we have, in-person events. We do a lot of celebrations, articles written by you as well as our company on current up-to-date things, and a lot more than that. So if you aren't following us yet, I do hope you will. If you are not familiar with Handle, we have an exciting platform that is purposely built for the building material suppliers. We manage job research, lien rights management, have a great waiver compliance, as well as a payment portal. Just a little housekeeping today. I will manage the chat box as well as the Q&A. If you have any questions, you can raise your hand or take yourself off mute and ask it directly there, or you can just put it in the chat box or the Q&A and I will ask it to Troy directly. I want to go ahead and introduce Troy. He is the principal for the unclaimed property for Baker Tilly. He's been with them for over 2 years. He is also currently the bylaws and ethics co-chair and past president with the Unclaimed Property Professionals member group over the last 11 years. He received his bachelor's from the University of Mary and published author in the Lorman and the Sun News.
So while I've only been with Baker Tilly for 2 years, I have been doing unclaimed property for, I think I'm going on about 18 years now. So straight out of the University of Mary, kind of went into working with companies to help them get compliant with unclaimed property rules and regulations. So before this, I was with a smaller firm that then merged into Baker Tilly. And as I was just telling Lori prior to this, I've worked anywhere from the Fortune 10 down to, small dental clinics to construction companies, helping them within the unclaimed property space. So, and I welcome questions as we go through. So, look to Lori to, help me facilitate that. But, definitely look forward to a more interactive discussion with you all today. So today, what we're going to talk about is just give you a little background about what unclaimed property is. Some of you may have also heard the term escheatment. So that is, they're intertwined. They're kind of the same thing, synonyms of each other. We'll talk a little bit about some trends that we're seeing that might affect your particular industry or your companies. We'll dive a little bit into the specifics of unclaimed property and accounts receivable in the credit world, because that tends to be where a lot of companies get hung up on what is truly unclaimed property. The rest is a little bit straightforward. I use that term loosely. There's not a lot of straightforward in this. We'll talk about record retention, which is going to be a little bit different than probably what you're used to. And then also go into a little bit of audit considerations that you and your company should be aware of. So first, what is unclaimed property or escheatment? So the true definition of it is property held, issued, or owed in the course of a holder's business that has gone unresolved with the owner for a specific period of time. Now, this will be the only actual words I read off of my slide, but I just kind of want to make that a point of breaking down this actual definition. So property held, issued, or owed. What we are talking about is intangible property. The only tangible property is safe deposit boxes, which most of you probably don't have. So we're talking about intangible property, checks, credit balances, and we'll get into a little bit more of that. But what we also want to know is that it is fixed and certain obligation to an owner. So it's still property that you are holding. So that is a credit, that's an outstanding check that is owed to an owner. And that owner is very specific of, if there's a name and address attached to it, that's going to tell us where to report it. We'll get that into a little bit later. And then holder, that is you, because you are still holding the property. So that's the business that is responsible for reporting it. And then the specific period of time, that is what we call a dormancy period. And we'll get into that a little bit as well. So this definition really kind of breaks down into all of the little pieces that we're going to talk through about escheatment today. So you are the holder, you have property potentially on your books, owed to someone else, and it has to stay there for a period of time before you can report it. Most states typically won't take the property before that period of time has passed. So what is that intangible property that we're talking about? So accounts receivable in the credit department. We'll dive a little bit more, but we're talking about credit memos, overpayments, unapplied cash, anything to where a rebate, something to where a credit is owed to the owner and they have not claimed it yet. Accounts payable and payroll, a little bit more straightforward. You're talking about an outstanding check. So it's still sitting as outstanding, but we also have to be careful. If you are just voiding checks to clean up your outstanding checklist, that could be potential unclaimed property too, because that amount is still owed. Just because you said your void date has passed, that doesn't mean that you can just void that check off. So we're talking outstanding checks and potentially voids. Those are the big three. Everyone's got customers, everyone has vendors, everyone has employees. So typically you want to review for those three types of property. Then you get into any of the other hundreds of different types of properties that could be out there. Employee benefits. If you have workers' comp on cash checks, you may be using a third party, but are they reporting on your behalf, or are they sending that money back to you? Oil and gas, revenue suspense, gift cards. We're getting into the holidays. Everyone's buying gift cards because, it's hard to buy for people these days. But could the gift cards be unclaimed property? So if you're issuing that, or if you got a $2 Starbucks card, everyone uses Starbucks. You got a $2 Ruby Tuesday card and you haven't gone back yet, that could be, you might still be owed it, or Ruby Tuesday may have already escheated that property to the state. Rebates, warranties, insurance, policies. So depending on your industry, and I know we're talking mostly to construction here, you could have additional property types that you want to be reviewing for. So what does a company have to do with unclaimed property? Well, you've always heard the saying, death and taxes are certain. Well, I also did teach accounting for 1 year at my alma mater after I graduated. Thankfully, I didn't have to do a class on tax. There's a whole track of tax classes. What they don't teach you is unclaimed property. And guess what? Unclaimed property is as much a law to file in every jurisdiction as a tax. Every jurisdiction, and when I say jurisdiction, I mean the 50 states, DC, Guam, Puerto Rico, and the US Virgin Islands all have unclaimed property laws. I can get into additional international, such as Canada, that is starting to get a little bit closer to US laws, but we'll stick with the domestic side today. In all 54 of those jurisdictions, you have a requirement to report and track unclaimed property. They never teach you that in school, but it is something that you have to do. So what does your company responsibilities include? So it is to identify and track that source of unclaimed property. And this is an annual file. Have internal controls over the unclaimed property. So I mentioned having just an automatic void process. We'll talk a little bit about an automatic write-off process for debits and credits on AR. But are you truly maintaining controls over those? Because if you're just moving them into income, then you're not properly reporting that as a liability on your books and records. Every jurisdiction does also require you to perform due diligence, which means reaching out to the owners of this property before you report it. So we'll talk through, how that is done. File and remit the funds. To mention, it's an annual filing. Every state's a little bit different. There's 3 reporting cycles we'll go through, but there is an annual reporting requirement. And then record retention. And I mentioned we'll talk a little bit about that because that's usually where I get the deer in a headlight look regarding what I'm going to tell you about maintaining documents and records. So the first thing that you need to know about is, even though reference tax, unclaimed property is not a tax. It's very similar, but it is not a tax. So your nexus standards do not apply. You do not need to have a physical presence or any presence in a state to potentially have to report unclaimed property. So back in 1965, the Supreme Court ruled in Texas via New Jersey, and this still stands today, the dormancy reporting rules for unclaimed property. And that first priority rule is if you know the owner's last known address, that is the state that you report unclaimed property to. So again, this goes back to the owner, not where you're located or anything related to that, but where is the owner located? Thankfully, my mom is a very large pack rat, and she also was like, you get all of your old stuff. So I got all of my totes that I came back and went through, and I found these 2 lovely envelopes that I received back for birthdays in, it's like 1989. This is how mail was delivered back in 1989. Now, if anyone really wants to see why this was delivered, Google Petersburg, North Dakota. The town of about 200 people, everyone knows everyone. So the fact that there's no zip code, there's no street address. Now, I lived on a farm outside of that, but it still made it to me. So that was able to be delivered. I live in Chicago, Illinois today. Do you think these would be delivered to my address in Chicago, Illinois if it was like this? Absolutely not. It probably wouldn't get delivered to Petersburg, North Dakota today either, but when you think about what really is an address, and states have started to look at this. So some states require that the address be sufficient for the delivery of mail. Well, I could argue this was sufficient for the delivery of mail because it made it there, but in the true definition, there's no zip code, there's no street address. It's probably not sufficient. I was just on a family trip to Santa Fe, and there's a sign that says Las Vegas very soon. Well, all my family was like, oh, Vegas isn't that far. Like, that's Las Vegas, New Mexico, not Las Vegas, Nevada. So just because you have a city, are you sure it's Nevada? Even though, like, Las Vegas, New York, you would think you know what that state is, but maybe you don't. Well, then some states have realized, maybe just as long as there's a state reference. So the state of Delaware now says, as long as you have a state indicator, you should report it to that state. So based off of this address, you could have two different interpretations of where to report this property. For these two addresses, we would still say I would report it to North Dakota. Now, if you didn't have the address or you feel it's incomplete, or you don't know who the owner is, that is then reportable to you, the holder's state of incorporation. Why do I mention Delaware a little bit ago? Most companies are incorporated in the state of Delaware. So North Dakota and Delaware have roughly the same population. And again, we report property to the state of last known address. Delaware takes in $500 million of unclaimed property a year. North Dakota takes in about $5 million every 2 years. Delaware gets a lot of owner unknown estimations, reach back period, what we'll talk a little bit about under audits, all because of the second priority rule of state of incorporation. So the takeaways here is if you know the last known address and at least that you know the state of it, that is the state you report unclaimed property to. If you don't have that address, then you report it to your state of incorporation. So as I mentioned, every jurisdiction or every state has this requirement, but they all differ because, what state could ever be too similar? So I talked about dormancy periods. So the property has to remain on your books for a period of time. So typically for payroll, we're talking about uncashed checks for 1 year. So most states have said this is stuff that really relates to a person. We want to get that property back to them as quick as possible. So typically most states you have to hold the uncashed payroll checks for 1 year. There are some states that are still 3 to 5, but typically for wages, it's 1 year. For outstanding AP checks and your accounts receivable credits, it is pretty much 3 years across the board. There is about a couple of 5-year states still out there, but typically these have to be held on your books for 3 years before you report it. So you'd want to be working with your customers, trying to get that property back. But after 3 years, that is where then it would become due and reportable as unclaimed property. And then looking at your other property types, traveler's checks, money orders. Who's bought a traveler's check in a long time? Probably not too many. But those are like up to about 15 years. Gift cards sometimes are like 7. So again, you have to look at each different type of property. But for the big 3, you're looking anywhere from 1 to 5 years that you have to hold that property.
Hey, Troy, we have a question.
Yes.
On the gift cards, does it make a difference that now most of them charge a percentage or a late fee when it goes over a year that you haven't used it?
So there is some issues around that. So a number of states do exempt gift cards as long as they do not have expiration dates or service charges. By adding a service charge, a number of states then make that gift card reportable. So you'd have to look at, first is gift cards can get very complicated. A lot of companies set up what they call a gift co in a state that exempts gift cards. So then, if you're not collecting name and address, you never have to report it. So you look for a state that has kind of a blanket exemption, which we'll talk about on the AR side here in a second. But if you are collecting name and address and you are looking at that, then you have to look at each one of those states Now, some states allow for the application of a fee up to a certain dollar amount. They kind of say it's a reasonable amount, but typically not to just zero out the card itself. So let's move into exemptions. We mentioned a lot of states have exemptions for gift cards, but the other exemption that everyone loves to take or think that they have is what we call a B2B, a business to business exemption. So in certain states, they have said, hey, company A, you're doing business with company B. We're going to stay out of that. We believe you two can work it out. We want where it's owed to John Doe, Jane Doe. We want the individuals. That's who we're here to protect in this unclaimed property. Businesses, can, work it out themselves. Fortunately, most states don't. Unfortunately, most states do not have these exemptions. And states are actually starting to retract these out of their laws, because it is kind of a moneymaker for them as well. So what you have to look for if there's a B2B exemption available in a state, some of them have additional requirements, such as it still has to be an ongoing business relationship. So if they're an inactive customer, it wouldn't apply. Some say it's credit memos only. So an overpayment, an unidentified payment, that wouldn't apply. But if you had a return and it's a credit memo or it's a rebate credit memo, that would apply. So now you have to look at, okay, what is that credit type? A lot of states limit it to AR, which is good, but some states do have a blanket exemption that would also include accounts payable. Ohio is one of the more broad states that has that applies to both AR and AP. And then you have to look at what does qualify as a business. If you're making payments to state governments, are they a customer or are those tax payments, certain required payments? Is a sole proprietor, because you're issuing it to a name, are they a registered business under that name or are they just an individual? So then you have to kind of look at what actually represents a business from there. And there is no de minimis exemption. So we used to have one in Idaho, but at this point, they've pretty much all been eliminated. So I hate to tell you at this point, but even a penny could be unclaimed property. And we'll talk a little bit about how you can track that, but we have filed reports for less than $1 to states. So if you want to stay compliant and, report when things are due, there is the potential that you could be reporting, pretty small dollars through this because there is no de minimis exemption.
Roy, we got another question. What is de minimis?
De minimis is a small balance. So for instance, Idaho had anything less than $25 you didn't need to report. They have now taken that out of their law, so you would even have to report anything for a penny. We'll talk a little bit about AR write-offs, where we have another word would be a tolerance level, to where at a certain point you're like, hey, below this amount, we're just writing it off, we're not dealing with it, kind of something around that. So at this point, what you just need to know is all property, regardless of dollar amount, is reportable.
Thank you.
So then due diligence. I mentioned this is where you have to reach out to the customers or vendors prior to reporting as unclaimed property. We are at a point now where every jurisdiction does require it, but again, every state's a little bit different. Most states say that you have to only try to contact the owners for amounts $50 or greater. If you have something below $50, you don't need to send a letter to it. There are a couple states that do require anything even for a penny. New York and Connecticut are the two there. But then you have a state like Texas who says you only have to send a letter if it's over $250. So again, you see the difference. Every state's a little bit different. And, if you're sitting in Oklahoma and you have property due to Connecticut and you have property due to Texas, yes, even though you're in all three of those states, the Connecticut one, you have to send a letter for a penny. But if the Texas amount is $50, you don't need to send a letter. So you have to look at each state requirements to determine what your requirement is. It's not just one or the other. These letters are typically required to be sent 60 to 120 days before the report is due. So that is the requirement. Of course, we're here to say, don't wait the 3 years to start doing due diligence. Work with your customers well before that to try and get their money back. But if it's still sitting there, then this is the required due diligence mailing. You do want to be very specific about the property in question. So putting credit memo number, check date, property type, dollar amount, date, all of that, you want to be very specific in the letter. And then there are certain states that do require specific language on their letter. For instance, California tells you what font and how bold it needs to be, and it needs to go on the very top of the letter. And then I think North Carolina has a footnote that needs to go there. So what you can do is look at each state requirement, combine them all into one letter. So you kind of have every requirement on one template, and then use that for all of the states based off of the dollar amount.
Troy, we have a question, and I kind of see your note there. They're asking, is there an easy site to find all these laws from state to state? I see your thing on a template. Is that something you'd be willing to share?
So one thing that you can get all of these laws is Baker Tilly does have a state-by-state guide that if you go to our website that you can download, and then it gives you the link as well as a lot of this information on a state-by-state basis. So that is a great tool. Lori mentioned in my intro, the Unclaimed Property Professionals Organization, UPPO. That's another great resource that has a lot of this information out there.
Thank you.
And then I believe if you go to unclaimed.org, that is the National Association of Unclaimed Property Administrators. So the ones that are, managing these laws, they've got a state where you can click on, or a map that you can click on each state, and it'll take you specifically to their unclaimed property sites.
Thank you.
Yeah. And then, as far as a template, it always kind of varies, that is something a little proprietary, but, if whoever asks that, wants to reach out, we can kind of work with them and help them on that as well. So then after you perform that due diligence, this is where now you report the property. So anything you didn't resolve via due diligence now gets reported to the state. So as I mentioned, there's 3 reporting cycles. We just went through the largest one where about 42 states are due, and that's October 31st and November 1st. Our next reporting cycle is the spring, which starts on March 1st through about May 1st. There's about 7 states that have due dates between there. And there are a couple in the summer, California, Texas, and Michigan. California is the one state that, always wants to be different based off a lawsuit. They have a report remit. So you actually report to them in November, and then you don't pay until June 15th. That's a different conversation that if anyone has questions on, we can definitely get to. But that's the June 15th date. And then Michigan and Texas are due July 1st. Now, this is for typical corporations, so that probably should cover everyone on this call. But if you are in a different industry, such as banking and finance and insurance, you may have different reporting dates than what I just went through, as those are sometimes done a little bit different within the states. So based off of that, what we do recommend is definitely setting up a compliance calendar. It is a year-long process. So you want to set up kind of a process and a policy and specific guidelines for when you should be gathering your data, when do you do your due diligence, the exemption review, which I should note, exemption should only be done after due diligence. Because an exemption means you don't have to report it to the state. It does mean that you still potentially owe it to the owner. So you still need to try to do the due diligence before taking the exemption. Then preparing the report, paying it, and then making sure that you do your reconciliation post-escheatment. I cannot tell you how many times that we report property for a client, and then they send us the same property the next year because they never took it off of their books, even though that they paid it to the state as unclaimed property. So you want to make sure once you report it to the state that you clean up your books for the post-escheatment process. So, a sample timeline, as I mentioned, we just kind of went through the fall reporting. So this is kind of a snippet of kind of what that first section looks like. So from, what I should also mention, so Baker Tilly, for what we assist clients with is the reporting of unclaimed property to the state. So we do annual compliance for clients, and we also do consulting, helping them get voluntary disclosures, policies and procedures, exposure quantification. So when we're helping clients do unclaimed property reporting, we kind of start every report year off around June 1st. That's kind of our new report year every year. So from June to July, that's where we're asking for the data. That's where you want to look and say, okay, our cutoff was X date, and now we know that it's a 3-year dormancy period, or it's a 5-year dormancy period, or we're going to take everything from a specific date, maybe 2 years old. Now we're going to move that into unclaimed property. So we can't resolve it with the customer up to this point. Okay, that's what we've identified as our unclaimed property. So then from middle of July to August, that's where then we take that property and do the due diligence. We're sending out the letters that are required by law. We give them about 30 to 45 days to respond to the letter. If they want their property, we either reissue the check, put the credit back on the account, and then anything that's left over, now we've identified as our potential starting population for reporting. That's where then we look to see, do we have any exemptions or deductions that we can apply? Take those off. And then that's where you now prepare your fall reports. So you want to start doing that by the beginning of October. So you have plenty of time to prepare the report, upload it to the state, make payment all before the October 31st, November 1st deadline. And then post that, that's where then you go back and make your journal entries and kind of clean up your books to make sure that everything that you paid to the state is, removed. Then we kind of start the process again with the due diligence letters for the spring and summer states and kind of go through those steps again. And then once we're done with those, that kind of repeat or completes a full report year. But these are kind of your main steps that you want to kind of make sure to set up who's responsible for them, when are you doing it, deadlines, and this will make the process go a lot easier. So let's talk a little bit about some trends in unclaimed property of what we're seeing now that we kind of understand the full picture. As I mentioned, every state and jurisdiction does have an unclaimed property reporting rule. Some states are now adopting what we call the Revised Uniform Unclaimed Property Act. We kind of laugh at that because no two states are uniform or the same, but a lot of them are taking this to update their laws. A lot of original laws were created back in the 60s and the 80s, well before electronic payment methods, changes to rules, electronic banking, email. So this new act is trying to kind of bring a lot of the states into the 21st century. So with that comes changes in dormancy periods, changes in due diligence requirements. So we do have to always kind of stay on top of our states making changes to their unclaimed property rules. One we just saw, which will be very interesting, it hasn't gone into effect yet because even the state hasn't realized how to implement it, but Connecticut is now requiring if you have an email address for the owner, you are required to send your due diligence letter via email. So a lot of states say you are required to do first class mail, and if you have email, you can. Connecticut's the first one to say, if you have email, you must email. Well, now it's getting into, do you have consent to send the email? Have they consented to receive this type of document in the email? A lot of you, if anywhere your clients have agreed to consent to receive emails, talking about unclaimed property probably wasn't in there. So is that still a requirement? And the state also wants that on the report. Well, there's no place to put an email on the report right now. So we're still working through that, but those are the things that we're starting to see as we probably are going to see a trend more towards electronic due diligence versus sending it via first class mail. And then the removal and expansion of exemptions. So we are starting to see Illinois remove their business to business. Both Colorado and Idaho have removed their de minimis payments. So we're starting to see where states are saying we're taking away exemptions rather than increasing them. Though we are starting to see a few more exemptions around that stored value cards, gift certificates, mainly if you don't have expiration dates and service charges on them. And then the other thing that everyone should be aware of, and again, this unclaimed property is industry agnostic, and it can be from a mom and pop grocery store all the way again to the Fortune 10. States are getting away from these large 30, 40 state audits and getting more towards looking at companies in their state that aren't filing. Now, you probably file taxes in all of your states that you are in. If you're not filing unclaimed property reports, they're starting to do kind of some backdoor research to see who's filing taxes and who's filing unclaimed property reports. So if you get questions, sometimes that's how they identify you as a non-filer for unclaimed property. So we're starting to see an increase in what we call a self-audit. It means your state where you're located sends a letter saying, hey, we noticed you haven't either filed in a while or you've never filed. Here's an opportunity for you to do a review of your books and records, report any past due property without any interest and penalties, and then continue to file with kind of no questions asked. So, you should make sure your corporate kind of mailroom or your C-suite is aware if they receive one of these letters to take it seriously. Because if you don't respond to it, that could lead to a full-blown third-party audit where additional states could join. So we are starting to, I have a list of states here that have been really active in this. So I mentioned New York, Florida, DC, Minnesota, Illinois, Indiana, Washington, and Utah. This isn't an all-encompassing, it's the ones that we've seen kind of the most in. And I think we're starting to see a lot more states adopt this to try to, be a little bit more holder friendly in ways of increasing compliance going forward. If you are a Delaware incorporated company, you do need to be aware of their VDA program that they invite you to. They are required to invite you to a VDA program before they put you under audit. But if you ignore the VDA invitation, that will lead to an unclaimed property audit. And then if you are filing in Delaware, they've definitely increased what we call a verified report, where they ask for a copy of your unclaimed property policies and procedures, as well as seeing if you have any past due property to report. It is reviewed by a third-party audit firm, so you have to be very specific on how you're responding to that. So again, if you're receiving any correspondence from the state of Delaware, definitely, take that seriously.
Question, Troy.
Yep.
So you said that you have to have an unclaimed property procedures in writing. What happens if you do this and you do it right statewide, but you don't have that in writing?
Great question. We have a number of clients that do not. So we're very upfront with Delaware where we say, no policies exist, and especially when they're using a third party, it kind of helps a little bit in that sense. But if you've been filing, that is great as well. What Delaware will typically do is send you recommendations for creating a policy. And we would recommend creating one because our thought is, and Delaware didn't deny that this would probably happen, is 3 years from now, they might ask for a verified report again from the same entity to see if you've implemented a policy and procedure. And if you haven't, then that could maybe mean that it goes into a little bit more of a deeper review. So it's okay in this first go around if you do not be very upfront about that, but I would work towards putting something into place because we don't know if Delaware will come back in a couple of years to see if you did put something in place and then do a review from there.
Yeah, it does seem like something that would definitely be a red flag for a follow-up audit.
Yeah. And one thing we noticed too, I don't have it on here. So Nevada, which is probably our most problematic state right now, if you report a day late, a penny late, it's a $5,000 penalty.
Wow.
They will abate that if you go into their VDA program. Now, they don't tell you which VDA program you're going to go into. One's way more complicated versus one's more high level. Each of them require copies of your policies and procedures. But what we've also found out is they require like a Nevada addendum to your procedures that say, okay, here's Nevada's laws for us. Here's their dormancy periods for us. Here's the due diligence for us based off of your company and the property types that you have. So just something to think of if you're, heavy in Nevada or want to work with them, that's something they require. So they're getting a little bit more difficult. Nevada is the only state that doesn't allow for consolidated reporting. So if you've got multiple operating entities, they want to report for every single entity, versus most other states prefer that you submit one consolidated report for all of your operating entities. And the last thing on here, which has been great news for holders, is so California did not have any sort of voluntary program in the past. They've now implemented a voluntary compliance program, which is, at this point, pretty easy to use. But prior to that, it was 12% annual interest. So it's great news for California. So real quick, kind of going through accounts receivable, just some high level where AR exposure may be. So trade AR, we'll dive into that a little bit more. unapplied cash, suspense accounts. Of course, if you've got money back and you can't get it back to the rightful owner through a lockbox or anything like that, that would be unclaimed property. We'll talk about write-off accounts. Bad debt accounts, you're probably wondering, well, why do I have bad debt in there? If you're receiving offsets or if you're reducing bad debt with your credits, you can't be doing that. So just kind of make sure that you're accounting for bad debt correctly. And especially if you're getting recoveries, document that well. Because if you're just taking a recovery of bad debt and not applying it there, sometimes auditors will look and see like, hey, where did this money come from? And then miscellaneous income expense, typically that's where we see tolerance write-offs going to. So you want to look at those accounts. So for aged credits, typically we are looking for customers in a net credit for inactive accounts. If they're an active customer and they're constantly doing business, I treat AR as a bank account. If they've done a payment, if they've done an order, kind of like a deposit removal, that date kind of constantly updates the date of last activity. So if they're an ongoing customer, even if they're a net credit, you wouldn't need to report it. You could, but you wouldn't need to. So we're really looking at your inactive customer accounts in a net credit position. That is what we would be looking for in the unclaimed property liability. So anything in a debit customer, even if there's a credit, if they owe you money, you don't have to report that to the state. Verify the date of last activity. That is your dormancy date that we've been talking about, but it must be customer generated. Just because you made a posting to the account for an internal reconciliation, that does not count. It has to be customer generated payment purchase email. And then related customer accounts. So if you have parent child, determine, how do those work together? If they're making payments separately, then you probably can't net them. But if they're all paying together, then you could absolutely net your parent and child related customers. And also make sure to do that owner outreach prior to doing the due diligence, so you're not waiting 3 years.
All right, we have a question, and it actually sounds familiar to when I used to do it. Say you have a customer that made a double payment. It's over a year. They won't let you apply it to current invoices, but the current invoices are past due and they don't have any current. So you have a credit sitting out there. They have invoices due, but they won't let you apply to it, but they're not buying anymore. So it's kind of like a bad debt sort of thing, but they have a credit balance.
Yeah. So if you eventually write it off to bad debt, you absolutely could apply that amount to that open balance.
So if you write it off, you can actually pay the invoices without them telling you so.
Yeah, because if you've moved it to bad debt, you've taken the ability for them to, pay it as well. But now if they eventually pay in the recovery and you've applied this credit and now it's an overpayment, that would then become your unclaimed property.
Good to have you to explain that.
Yeah. Now, if you haven't moved it to bad debt yet, again, it's going to stay as a debit balance, like a net debit for the customer. Then I wouldn't report that until you move it to bad debt, and then it still is offset. Now, if the duplicate payment is more than the open invoices and you're sitting with a credit amount, then after the 3 years, you would report that net credit of the duplicate payment and invoices together.
My guess is most companies don't leave a credit balance for 3 years anyways.
Which takes us to write-off, which a lot of companies are like, hey, we've got this threshold, we're not dealing with it, or, like you said, 2 years later, we're going to just remove the credit. I'm not saying that you can't do this. I'm just saying you have to review it a little bit more for unclaimed property. So let's say you've got that $100 threshold for anything debit or credit is written off no matter what. Rather than just moving it to bad debt or moving it to an income expense account, move it to a clearing account, a suspense account specifically for this purpose, and then do a quarterly, semi-annual review where anything that is and again, it has to be customer by customer basis. So make sure you have all your customer information. If you've written off a net credit, okay, move that to the liability account for tracking. If you've written off a net debit, which you're writing off more debits than credits, we understand that, then you move that into the normal process, whether it goes into bad debt or the miscellaneous income. But if you are writing off a net credit for a customer, that is potential unclaimed property. So, don't take away your tolerance level or your de minimis review, but you do need to have kind of this extra step to be reviewing it And then while you're tracking the net credit, if a year later a large debit comes through, you can still offset it. It doesn't have to be within the same year, but just don't use the debit more than once to offset a credit. So there's a little kind of reconciliation that needs to happen here, but this is just a good way to make sure your AR write-offs are included in your unclaimed property review. I was working with a publicly traded company that had to restate about 7 years worth of their financials because they were taking AR write-offs into income. I think Lori was in my session when I pulled up their 10K where they talked about this. So if you don't want your department to be listed in a 10K of why you have to be redoing your financials or any document that says you're redoing your financials, you want to treat your AR write-offs correctly.
Thank you.
So real quick, here's the deer in the headlight look for record retention. It's not the 7 years. For unclaimed property, it's anywhere from 13 to 15 years. So states require that you keep the support for 10 years, and then you add the dormancy period on. So that's 3 to 15 years worth of unclaimed property reports and supporting documentation that you are supposed to retain. So what do you retain? Aging reports, unclaimed property reports. If you have an ERP system conversion, download as much as you can from there. See if you can get line item detail versus batch transactions, invoice copies, journal entries, correspondence, bank reconciliations, and statements. This is a lot of times where people are looking like, do I have to go back to my record retention and tell them they need to change all of this? It's a conversation worth having of how this should be handled. Now, you may be able to download, one thing at the end of every year and kind of keep it in a system, but this is something that should be discussed with your record retention team because under an audit, they can go back at 13 to 15 years. And if you don't have records, they have the ability to do estimations, which is again why Delaware makes so much money, which takes me to the audit considerations where I said 10 years, estimations, on the AR side, they're going to try and track credits to see where they may be written off to. They're going to try to identify any write-off accounts. And then they're going to review any checks voided more than 30 days from issuance. So you want to make sure that you have as much information and documentation as possible. So, establish those reporting procedures. So this kind of summarizes everything we've talked about today. Get a process in place, even if it's a one-page little chart, get something in process to where you're at least looking at this. Talk about what your write-off policy is, make sure everyone understands it and how it could potentially affect your unclaimed property. Talk with your customers on a more frequent basis. If you're not, try to do an annual true up. Hey, we have these debit credits. Let's just agree at the end of the year. If there's an amount left over, they pay. There's a credit, you issue a refund back and start off, or get a written agreement that things are owed per se. And that goes back to getting all correspondence in writing from vendors and customers. So if you have a conversation with them, they're like, hey, you don't owe us that amount. I don't know why this credit is sitting out there. Follow back up with them in getting that in writing because the state can only have the same rights as the owner. So if the owner says it's not ours, the state can't take it as well. So I think I went way longer than I was probably expecting to, but that's good with questions. But is there anything else that anyone would like to bring up or have questions on regarding unclaimed property?
It looks like you answered them all as we went. That was a lot of information, Troy. I think everybody probably realizes what a hot topic this is to go into 2025 with.
And typically it's never going to fall in the credit AR department, but you are a key part of it. Filing typically is, maybe in the finance, sometimes tax because it looks and smells like a tax. But, if your company is not doing it, they're not asking you about credits, you might want to raise your hand and tell them to get some more information. Again, I don't want to plug for us, but there are many companies like Baker Tilly out there, so not just us, that you can do research on that assist companies that have never dealt with this before and want to get into compliance, or if you are doing it and it's just too much, that you can outsource. And then it is the holidays, so if you haven't gone out and looked at missingmoney.com, you may be owed some money yourself. I just got $46 from the state of Illinois. So go to missingmoney.com, put your name in there. Quick tip for your company: if you're not filing unclaimed property, don't try to go and claim unclaimed property because that's going to be a first red flag. But your company may have money out there too. But again, you might want to be reporting before you start asking to get your money back.
Now, we do have a question that came through, but really quick on your looking yourself up for money. I do that every year, and I've probably got over $1,000, through the years looking my own name up. Make sure you look your own name up in whatever state you lived in as well,
Yeah.
because I have so much money from Washington. I don't have any in Texas, but it's out there.
It does. And they have to hold it in perpetuity. So even if it was 10 years ago, you can still claim it.
Nice. Question is, do the laws change for governmental accounts?
So I guess could they be more, when governmental accounts, do you mean you are a government holding the property or your customers are government?
Customers, yes.
Yeah, they would fall under the same rules and regulations, where the one issue with the state government is under an audit, they're now determined not to be included as part of an estimation per se, but they would be still reportable to the state in which the government is located. I will say federal government agencies or any federal government customers, those are exempt from unclaimed property because, of course, no state can take federal money. But if it's state, local, county, municipalities, those would be reportable following the same rules as everyone else.
So I'll add on to that. So if it's unclaimed property, I mean, you're notifying the state. It just seems like it'd be tricky.
It does. I mean, we just cut a check to the state of Arkansas because they claimed property from one of our clients. And that's, you have to kind of look at what is the payment for? What is the customer? Now, if they're purchasing product, building, they're treated as just any other customer. A lot of times, if you send a due diligence letter 3 years later, they're like, oh, well, we closed that year. We can never, we can't take it. You would still report it to the state, and then it's kind of, whether that state ever gives the money back, it might just kind of sit out there. But ultimately, the state still gets it of probably where it was supposed to go to.